Many of you have been concerned with the strength of the US dollar, and we're going to talk about that, but it begins with looking at the strength of the US economy. We're going to cover all that in today's market update. Let's get into it. Okay, so in just a minute, I'm going to show you a chart of the US dollar that is going to be a big surprise to many of you. But first, like I said, we got to look at the strength of the US economy, because that is the most important factor in the long run to where a currency goes. All right, we have talked a lot about the US economy here in videos over the last year and a half. And just a refresher in case you're new to Sentara Capital, at the start of 2023, over 90% of economists were forecasting a recession. That didn't come to pass, and we believed the strength of the US economy was going to be strong enough that a recession was not going to happen. The main reason for that was the strength of the jobs market. We talked a lot about jobs. Our last video, if you want to check it out, was called Jobs Market Stunner. We looked at how the unemployment rate recently dropped from 4.3 to 4.1%, and we had 254,000 new jobs added last month. So we're not going to go back over the jobs info here, but we're going to look at some other pieces of data that can tell us about the strength of the US economy. The first thing we're going to look at is the Atlanta Fed has a tool called GDP Now that you can go and check that out. And what you'll notice here is that right now the Atlanta Fed is estimating that the US economy is going to grow at 3.4% for the third quarter. Now in blue there, that is the range between the bottom 10 forecasters and the top 10 forecasters. You can see 3.4% is higher than even the most optimistic forecasters are currently on the US economy. Also, what you need to know is in the second quarter, GDP grew at 3%. Now, this is super strong. A 2% growth rate in an economy is thought of as good. So 3 and 3.4% is very good. So this is positive. As of right now, estimates for the third quarter are going to be very good. Now, the next thing that we want to look at is inflation adjusted median household income. So this is the average family in the United States, when you look at what their household income is, adjusted for inflation. And that is important because we all know with the significant sky-high inflation that we saw in 21 and 22 and parts of 23, that really hurt a lot of people in this country and continue to, because prices are so much higher. Well, this adjusts for that. And what you'll notice going back to the year 2000, you will see that household income started to go up significantly in 2014, 15, back to where it was pre-financial crisis. And then it really broke out 2017 through 2019. Went up and set an all-time high at around 81,000. Then you see that dropping when COVID hits and when inflation hits hard as well. But it's been in the last year and a half, this has started to go back up. And you can see now is right there close to an all-time high. So this is a positive that for the median household in the United States, they have never had it better in terms of how much money they're bringing in adjusted for inflation. The next chart looks at the change in total wealth for American households going back to the fourth quarter of 2019, okay? This breaks it down by the bottom 50%, 50 to 90, 90 to 99, and you can see all the way up to top 1%. What we care about, we're not really worried about the top 1%. They're going to be fine. But for everybody else, notice the bottom 50%, they have had the biggest increase in wealth over the last 4 years, up 96%. Now keep in mind that a lot of people in this group didn't have a lot of wealth to begin with. So even though a 96% increase has happened, that's not a lot in total absolute dollars. But when you take a look over this whole cohort, this is a big deal. By the way, we have shown a couple of times over the last year and a half, when you look at income growth over the last 5 years, it's also the case that the folks in the bottom quartile or bottom 50% have had the biggest increase in their wages of any income level. So that is very positive as well. So the next chart is looking at the poverty rate here in the United States. And this goes back to 1990. You can see poverty rate kind of peaked up at 15% in the early 90s, and then following the financial crisis in 2010 and 11. It began to come down. It bottomed out around 10.5% in 2019. Of course, then COVID hits, and this goes up. But notice that it never went back up to some of the higher levels from the 1990s and after the financial crisis. Then it has started to come back down, and it is at the last known date here, 11.1%, probably now down under 11% in real time, but we don't have those figures yet. But this is very, very good news. Of course, we want the poverty rate even lower than this. You don't want anyone in poverty, but it is very positive to see that outside of about a year and a half, 2 years pre-COVID, this is the lowest poverty rate since 1990. Now, the last metric that I want to take a look at today is, you know, we like to talk about what we're hearing from company in their earnings reports and for their upcoming outlook. We are just now getting into third quarter earnings. We've heard from about 15% of companies in the S&P 500. One of them we've heard from is American Express. And again, we have talked about, we listen closely to American Express, Visa, and MasterCard. They have been telling us consistently the last couple of years that consumer spending is strong, and it has continued to be so. American Express put out this chart on their earnings report last week of the percent of card members that are having credit cards or loans 30 days past due. They become delinquent. And notice under third quarter 2024, it's at 1.3%. This is in the same range it's been for basically the last year, and it's lower than the 1.5% it was before the pandemic. This is good news. There is not a trend here of more and more of their card members becoming delinquent. Then when you look at net write-off rates, what percent of their loans are they writing off? Again, that it sits at 1.9% currently. That's on the lower end of the range it's been in on the last year, and that's lower than 2.2% pandemic. So when you take a look at these different data points and you combine that with the very strong jobs data that we've gone over recently, it's telling a picture of a U.S. economy that is continuing to be strong. Now I want to take a look at the strength of the U.S. economy from a different angle. We talked about the fact that GDP growth in the U.S. is projected right now to be 3.4% in the third quarter, but let's go back and look at the U.S. economy's growth rate going back to 2009, so over the last 15 years, and compare it to countries in Europe and in Asia. And I just want to mention for a second here to clients, the charts I'm about to show you are a big reason why we have had little to no exposure to international stocks. You know, one of the big things at the big banks and big financial companies is they want their clients to have 20, 30% of client assets invested in international stocks. That just hasn't worked out very well over the last 15 years. And this is a reason why. If you look at U.S. GDP growth going back to 2009 and compare that to Germany, the U.K., Japan, France, and Italy, what you see here, the U.S. is up at the top, almost 102% growth in the U.S. economy in that 15-year period. Number two is the UK at 82%. Germany is third at 77%, though I'll mention of late, Germany has gone sideways. In fact, they are currently technically in a recession right now. some bad policy. We won't get into that now. But number 3 here, France at 50%. 4 is Italy at 38%. And then last, Japan at only 21%, basically 1/5 the growth rate of the U.S. economy. So this has had a real impact. Now, that's over 15 years. I also have a chart looking at the last 5, and this is from a blog called The Wealth of Common Sense. They have a lot of good information there. This is looking from 2019 through mid-2024. The U.S. economy has grown at over 10.5%, and this is after inflation. I should add, after inflation, real GDP growth, 10.5%. Canada is at 5.5%. The Eurozone is at 4.4%. Japan 3.1%. The UK 1.7%, and Germany next to nothing there. So the fact is that the U.S. economy has been growing a lot stronger than most of these European and Asian countries over the last 5 years, but also going back 15 years. And that has made a big difference in the performance in stocks. The U.S. stock market has done far better than international markets. Now, this isn't always going to be the case necessarily. There are going to be certain times when we will want to have some international holdings, but it hasn't been the case the last 10 years that has been a good idea. Now, this brings us to the chart of the dollar that's a big surprise, because listen, there are some people out there who have been concerned about the strength in the dollar, and it's a reasonable concern given that we have gone from 17 trillion in debt 6-7 years ago to 35 trillion in debt now, and we are spending trillions of dollars more than we are bringing in tax revenue right now. So it's to be a concern. But take a look at this chart of the dollar. First, we're going to look over the last year. What you'll notice is it's had some big moves up and down, including from early July into mid-September. But look, in the last few weeks, the dollar has made a strong move higher. This has surprised a lot of people, and this is because of what we talked about to lead off when we said the U.S. economy is expected to grow at 3.4% in the third quarter. That's after growing at 3% in the second quarter. Listen, because our economy has done better than expected, the Federal Reserve is now not planning to cut interest rates as much as they were previously. And so with higher interest rates, that plays a big part in the U.S. dollar and where it trades. When rates are high here, a lot of international investors want to bring dollars over, so they come and sell their currency and buy dollars, and it strengthens the currency because they can get higher interest rates. So that is a big deal. Now, I also wanted to show a chart of the dollar going back 10 years. I got a point to make here. You'll notice on the far right-hand side, again, this had been in a decline. The dollar had been depreciating here. And this is over a basket of currencies. The euro makes up about 50% of this. The Japanese yen's a big part. A couple other currencies thrown in there. Notice, though, on the far right, the move up to 103.97. This just recently occurred. My point is, other than late 22, early 23, when this spiked to about 113, if you take out that 1 year, this goes back 10 years, where we are right now in the dollar is at the upper end of the range of where the dollar has been. In fact, if you look pre-COVID, we are today higher than the dollar was at any point from 2014 up to pre-COVID. That's a surprise to a lot of people who have been assuming, hey, the dollar is depreciating. I'm very worried about the dollar. What should we do about it? This puts it in perspective that says, hey, the dollar is actually still pretty strong if you look at historically. The bottom line is, for our clients, our job is to take a look at the strength of the U.S. economy, look at what the dollar is doing, but most importantly, see what impact is that going to have on company earnings. Because like we've said, in the long run, we're investing in companies and of course the bond market. But in the long run, if company earnings are growing at a faster pace, the stock market is going to do very well over time. Thanks for watching and take care. Hey, thank you so much for watching the video. Listen, if you are new to Sentara Capital, you can go on over to our website and see what all the fuss is about. On there, you can go to the contact page, reach out and talk to one of us, and we set up a 3-meeting process to see if we are a good fit for each other. And of course, you always can like and subscribe to the page so you don't miss a future video. Take care.